Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I just want to share with you guys my list of companies that I'm thinking of adding in 2021. The reason I want to do this is because I made a recent video where I talked about every single company that I own in my portfolio and from Sharia compliance side of it and what I'm going to do with some of these companies. So going forward, I want to share with you guys as well two-part video. So I want to do today show you 6 companies that I could potentially be adding to the portfolio in the next year, so 2023. And then the following video, I'm going to show you some of the companies that I feel like are undervalued, that are in my portfolio already, plus the ones that I'm going to add, and then I'm going to share that with you guys, my price entry, the watch list basically. So I do these watch lists. If you haven't been watching the videos, I do a watch list for every single 3 months where I talk about the company and my price target. So when it reaches that price target, is where I either add to the company if I had the stock already, or I purchase it for the first time. So I'm going to share that with you guys, InshaAllah, so you know exactly what I'm thinking, what I'm doing in the next 3 months. So when you see these companies in my portfolio, it's not going to be a surprise because I've already talked about them. Obviously, opportunity sometimes will come up, and then I might just take that, and there might be a company that I've not spoken about. But I like to share these things in advance, so at least you know where my head's at. So let's do the video. I don't want to make this a long video, so just to quickly, the usual. We're not looking at anything else. We're just looking at the market cap, the moat, the price, dividend yield, the latest increase, 5-year growth rate, payout ratio, how long they have increased that dividend, how much they pay in every single week, every single year in dividends. So the total amount that they pay you as in dividends. Obviously, if they pay quarterly, then it's that divided by 4 and so on. The safety, profit margins, return on equity, free cash flow, total return in the last 10 years. This year, the growth expectations for this year and basically the next year, and then the 5 years after that, and then Morningstar valuation and the fair value. Right, so the first company that I'm looking at is Eli Lilly, and this company is actually one of the basically pharmaceutical companies out there. So they have loads of different drugs that they actually are doing. So basically, there's some of the things includes diabetes and so on, immunology. Basically, they have a wide range of products, and this company has been overvalued for a long time. It's been on my watch list for a very long time, because some of the drugs that they have is actually quite popular, and the companies actually have been trading in higher multiples. So when you look at their PE ratios, it's always basically traded in the high multiples. So price to earnings right now we're looking about 53 on average. Basically last 5 years we're looking about 49. So it is quite expensive in comparison to the industry, so in comparison to the market. So the industry is basically the healthcare, and the market is the general markets. So when you look at that, that's actually quite expensive. And when you look at the PE ratio, forward PE, right, so based on their forecast earnings, is 42. So it's gonna come down at some point, but it is basically expensive right now. And also from price to free cash flow side of things, it looks expensive. So the company is Eli Lilly, and as you can see right now, it's trading $356 per share. It has a dividend yield of 1 point something, I can't remember, let me double check, 1.26. Latest dividend yield and increase was 15%, payout rate and 5-year growth rate is of 11%. So this is a dividend growth company, definitely. The payout ratio is 45% right now, dividend streak of 7 years in a row. So they have increased that dividend for the last 7 years, and right now they pay $4.52 for every share that you own of this company. Safety, that's per year, by the way, annually. Safety is 96%. There's nothing wrong with that. It's absolutely beautiful. 99% is the highest, if you like. Profit margin 20%. Return on equity 65%. Free cash flow $5.3 billion. Total return of 23% from the last 10 years. Next year is expected to grow 10%. Then 11% every 5 years after that. 31% premium right now. $273 per share is basically where the price is at right now. So that's one of the companies I'm looking at right now as we speak, and going forward, hopefully we will see. The next company I'm looking at is automatic data processing. This is one of the companies that does a lot of the human capital management solutions. Okay, so they work with other companies when it comes to anything to do with HR, and basically talking about HCM solutions, human resources, outsourcing, insurance, retirement services. So they do a lot of things. So they work with companies to basically manage an employee side of things. Okay, and as you can see right now, they trade in $242 per share. And this is another company that is actually quite expensive in terms of price to earnings, PE ratios. So right now it's about almost a 34. Basically, the average for the last 5 years has been 31, almost 32. Whereas the industry has just been 26 that's the tech sector, right? It's the technology sector. Basically, it's a tech company, but sometimes they put it under industrial, sometimes it is in the tech sector. So 20 in the market, but as you can see, it's actually trading higher multiples. Forward PE looks exactly the same, almost is 30. So it is trading a little bit high, but based on free price to free cash flow, I can't even talk, is 20, almost to 28. So yeah, it seems a little bit expensive right now. As you can see, $243 per share, dividend yield of just 2%. Latest dividend increase is 20%, which is absolutely amazing. And one of the reasons I actually like this company is the dividend side of things and the predictability of that dividends. 5-year growth rate 13%, payout ratio 58% right now, which is not bad at all. 61 and above that's when you start worrying about it. Dividend safety, we're looking at 47 years of increase in that dividend basically, and $5 is what they pay right now annually. Safety 97%, profit margin almost 18%, return on equity 80%, free cash flow above $1 billion right now, total return 17% in the last 10 years. Next year expected about 11% growth, 5-year growth rate of 15% in the next 5 years. If you like, 7% premium right now, $228 per share is where the price should be. And right now, as we look at, is 243. The next company we're looking at is Texas Instrument. This is one of the companies I've spoken about for a long time, and one of the reasons I've actually included in this is, although I have similar companies, the tech companies are beating up so much, but this company is still doing all right because it's gone up quite a bit in comparison to others, and their dividends are actually quite good. So I'm looking at it now. I'm not saying I'm definitely going to add to the portfolio, but I'm looking at it right now. So $152 billion company, and it has a wide economic moat, $166 per share, dividend yield almost 3%, and latest dividend increase was 8%, 5-year growth rate 21%, payout ratio 47%. 18 years of increase in that dividend, almost $5 for payout. Safety 90%, profit margin 44%, and return on equity we're looking at 63%. Free cash flow right now we're looking at about almost $4 billion. It has returned 20% into shareholders in the last 10 years, and right now next year they're expecting, just like all the other semiconductor companies including Qualcomm and so on, they will have basically a negative year basically, where they might not grow that business obviously, but the 5 years after that is about 10%. Fairly valued right now, $158 per share is where the price is at. Next company we're looking at is Canadian Pacific. This is one of the companies I have been looking at for a while, and it's actually a little bit expensive. I do like the railroad companies. Okay, so this company is a Canadian based company. They actually work on basically the across the border of Canada and the US, if you like. So it's one of those great companies that have a very predictable income, have been around for a long time, and the business is still growing. So I do like Union Pacific. Okay, I will be adding to it very recently. I've added to it very recently, and I will be adding to it as well. But yeah, so this is right now trading. It has a market cap of almost $70 billion. It has a wide economic moat, $74 per share right now. Dividend is just above 1%. Latest increase that is non-existent, so they haven't increased their dividend recently. 5-year growth rate of, if you like, I think they have increased, but I'm not sure why actually. Simply Safe dividend has given me a 0. But anyway, 5-year growth rate of 15%, payout ratio 20% only, so which is quite nice. So I'm sure they will be increasing this, and they have increased this dividend for 6 years, so that makes absolutely no sense. It will be interesting to find out why they put that in. Safety 76%, 33% profit margin, 7%, almost 8% return on equity. Free cash flow $1.5 billion, total return 15%. Next year they expect about 22%. 5-year growth rate, 5-year estimate is basically for the earnings it's about 8%, 13% premium right now. $66 per share is where the price should be right now. Accenture is one of those companies that I absolutely love. The business model is very predictable. It's a technology company, is a consultant company. It works with almost every single companies out there, and this is what I love. I love Accenture. I love S&P Global. These type of businesses that have a work with some of the largest companies out there that have a predictable revenue, if you like. $161 billion market cap. It has a wide economic moat, $256 per share right now. Price in terms of dividend yields 1.75, which is nice for a growth company. Latest dividend increase is 15%, 5-year growth rate of 10%, payout ratio 38, only 17 years of increasing that dividend. They pay you $4.48 if you hold if you have one share of that company. Safety 92%, which is nice. 11% profit margin, return on equity 31%. $8.8 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 15%. Next year, 10% growth in terms of earnings. Following 5 years will be 11%. Morningstar is saying it's fairly valued at the moment. I do agree with them. It has come down quite a bit in the last few weeks. $258 per share is where it should be right now, $256. So it's almost basically a fair valued right now. And the final company is Robot Technologies. I've talked about this company recently. It's another software company, another technology industrial kind of company, for almost a $45 billion market cap. It has wide economic moat, $424 per share right now. Dividend yield just below 1%, but the latest increase was 10%. Then the 5-year growth rate is actually 13%. Payout ratio is 16%, 29 years of increasing that dividend. Payout $2.73. Safety 98%, which is absolutely beautiful to see. Profit margin of 53%, and return on equity we're looking at about 22%. Free cash flow $1.1 billion, total return 15%. Next year they expect it to grow 13% and then 11% after that. 20% discounted right now, $530 per share is where it should be. Right now we're looking at $424 per share. So this is really a good company. I mean, overall they are great companies, all of these companies that we talked about today. But one of the things that I actually like about these companies is, apart from one, is this thing here from Sharia compliance side of it. Because like I said recently, I'm trying to basically earn companies or own companies that have a low debt, if you like. So from Sharia compliance side of it, this will probably be the only one I will be worried about. Okay, I wouldn't be worried about the rest of them. So Canadian Pacific, although I like the company, that's the only one that I would be worried more about, the Sharia compliance side of it. Because if you look at these rest of them, okay, even Robot Technologies is actually okay, 17.5%. As long as they don't increase that debt level, or the stock doesn't tank or whatever, then they should be absolutely fine. So I'm looking for companies that have a growth side of things and everything else that you need to look from valuation perspective, okay, in terms of growth and everything else, and then have a very low debt and very low interest-bearing security. So they don't have that much of a loan. They have to kind of pay all sorts of interest or whatever. So there you have it. There's 6 different companies that could potentially be added to my portfolio. So I'm going to stop the video there. I don't want to make it any longer than that. Have a wonderful day. I will be following up with another video just to show you my watch list for the next 3 months. So watch out for that. Assalamu Alaikum.